get in conversation with Shibani Sircar Kurian, the Senior Executive Vice President, Fund Manager and Head of Equity Research at Kotak Mahindra Asset Management. Shibani, good afternoon. Thanks so much for taking the time out and speaking to us at ET Now. First up, I want to understand that the correction that we've been seeing recently, the kind of fall that we've seen across indices, be it the large cap, the mid cap, small cap, do you believe that the valuations have corrected enough to make these stocks attractive now? Do you believe the kind of correction we've seen in valuations is significant enough for us to now confidently say that only good days are ahead?
Hi, good afternoon. So when you look at the correction that we've seen recently over the last couple of months, you must put it in context of what's happened in the last 4 years, especially since post-COVID period. Our markets have had a significant uptrend and it's been a one-way move in the market. And therefore, in that context, we must look at the last 2 months of correction and volatility as something that is possible, given that equity markets have seen such a one-way up move. Now, the correction that we have seen has been a mix of both domestic factors as well as global factors. And in that context, when we look at valuations, we have to look at valuations in context to earnings expectations for India. Now, India again had a significant up move as far as earnings were concerned. However, in the first half of FY25, we've seen fairly moderate and muted earnings delivery from corporate India. And even in Q3, while there is some improvement expected, it is still likely to be single-digit earnings growth. And therefore, from that perspective, valuations have to be in line with how earnings trajectory pans out for the rest of the year, as well as going into FY26, where consensus is building in about mid-teens earnings growth for corporate India. Now, when you look at different pockets of the market, large caps today are trading at a slight premium to their historic average multiples on a one-year forward price to earnings basis, while mid and small caps are trading still at about 30 to 40% premium, depending upon the index that you look at. So in that context, risk reward continues to be favorable for large caps because we believe that large caps, and especially post this correction, have come down to fairly healthy multiples. In the mid cap and the small cap segment, one has to be fairly stock specific and bottom up in terms of approach. However, also keep in mind that when we look at earnings as well as return expectations from the market going into FY26, one must moderate earnings expectation given the context, as we were discussing, that last 4 years have been a significant uptrend for our markets as a whole.
Right. Shibani, hi, this is Ankita joining in. Good afternoon to you. A couple of interesting things that you mentioned there. The kind of correction that we have seen, right now, that correction hasn't happened in the last 4 years after the run-up in the market, especially the mid-cap and the small-cap space, which had a lot of froth. But despite that, if I look at the data for mid-cap and small-cap, they both are down. They're just somewhere between 4 to 6% down from the 52-week high. Do you think there's still froth there, as you mentioned, that large caps are comparatively more attractive, and also because of the FII selling, which is likely to continue due to the elevated dollar index and the bond yield? Obviously, the FII sell in the large caps. Large caps clearly a preferred bet for you. What are the spaces or what are the sectors that you see value in?
So absolutely, as you mentioned, despite the correction that we've seen in the mid and small cap segment, and of course, stocks possibly have corrected in pockets higher than what the index is suggesting. But at an overall index level, both mid and small caps are still trading at a significant premium to their own historic multiples, as well as in context with where large caps are. So therefore, clearly the preference for large caps over mid and small cap is something that we are continuing with in terms of our strategy. Now, in terms of pockets of opportunity and sectors, there are a few sectors where we believe that valuations are favorable and hence risk reward, especially when you look at it from an 18-24-month perspective, is possibly turning favorable. The large private sector banks is one such pack. While there are, of course, near-term headwinds, credit growth has slowed down, there are pockets of asset quality stress, and margins have been under pressure. We believe that the valuations for that large cap banking space, specifically the private sector banks, is possibly more than capturing in these kind of headwinds. And as we start seeing improvement in terms of earnings profile going into next year, this is one pocket that we like. The second pocket where we have been positive on has been technology. Of course, the sector has seen a fairly sharp outperformance over the last few month period. But here we believe that the revenue growth improvement that is likely, especially with North America as a geography improving and discretionary spend coming back in pockets, specifically for verticals like BFSI, the runway for earnings expectations to improve is still there, and therefore technology is the second path. And within the consumer space, we believe that rural demand is starting to improve, albeit at a fairly moderate pace. However, there are again pockets of opportunity within the consumer space which play the rural theme or the mass consumption theme, where we believe that there is likely to be an improvement. So these are some pockets where we believe that valuations are still fairly reasonable. And from a sectoral perspective, that's how our positioning is at this point in time.
Okay, Shibani, so if these are the sectors you are liking, could you also give us your outlook on what you expect the quarter three earnings for these sectors to be like? Because we have seen offshoots coming in consumption, because on one hand rural is doing okay, urban has started to slip. You have mixed previews coming in for private banks and IT, like you mentioned. TCS was good, HCL Tech was a very negative surprise coming in on the commentary front. While all of that is on the fundamentals, tell us what kind of earnings are you expecting? What kind of earnings growth can we expect from the quarter three earnings season across sectors?
So absolutely. So quarter three will still be a fairly muted quarter. At a headline Nifty level, we are still expecting mid-single digit kind of an earnings trajectory. The top line growth remains fairly muted. And of course, the margin tailwind that we saw over the last few years has now factored in into the base, and therefore margin expansion seems to be fairly muted as well. So the numbers in terms of the overall earnings for quarter three will also likely be mid to high single digits. In that, if you take out oil and gas as well as metals as a space, the number will look closer to low double digits. So clearly two sectors that drag down earnings is oil and gas and metals. Within that, if you look at segments such as healthcare, technology to some extent is starting to see a revival in terms of earnings, capital goods. These are some of the segments which are expected to show better earnings growth trajectory, specifically on quarter three. For banks as a whole, this quarter will still be a fairly muted quarter in terms of earnings, specifically because loan growth has come off and there is going to be some degree of margin pressure as well as inch up in terms of credit cost. However, going into next year, and that's where our thesis, lies in. So if you look at FY26, one at a headline level, we do expect to see some improvement in earnings for overall market. And therefore, we are at this point in time penciling in mid-teens earnings growth, and therefore delivery of earnings becomes important. In that context, some of these sectors that we were discussing should start to see earnings improvement going into FY26. And of course, valuations in pockets remains fairly reasonable, both in context of the market as well as in context to their own history. And therefore, our preferred pick, specifically, especially as we were discussing in the large cap private banking space, some pockets of consumption and technology at this point in time.
Right, Shibani, you spoke about these sectors. Let me come to you about one sector, and that is the cement pack that has started to look attractive. Perhaps a re-rating on the cards, because the pricing pressure, the profitability pressure seems to be abating for the cement pack, and also with the government capex coming in, kicking in after the budget, there could be a demand revival as well. What's your take on the cement pack?
So cement as a sector, of course, has seen significant consolidation. And we believe that that bodes well from a medium to long-term perspective, specifically where pricing goes. This sector, of course, has underperformed primarily because volume growth has been muted. We've seen public capex come off. But remember, the sector derives demand both from infrastructure as well as real estate. Real estate continues to grow and chug along. So from that perspective, there is some support. And as you mentioned, as government capex does pick up in pockets going into the budget and possibly into next year, some amount of that volume growth improvement should be visible. Key for the sector is pricing, and that's where we need to watch out for trends. Over the last couple of months, we've seen some inch up in pricing, and the pricing is holding on. From a longer term perspective, we do believe that consolidation will bring about discipline and therefore focus on profitability for players. And this is a sector we believe that today valuations have corrected. However, as I mentioned, pricing is going to be the key factor determining how margins and profitability plays out. And in this context where there has been consolidation, the larger players are possibly better placed in this segment as compared to some of the smaller players which are losing market share. So we are fairly positive at the margin where cement is concerned, but however, we will have to wait and see whether the pricing trends, as we were discussing, continues to improve and therefore profitability as well.
Okay, Shibani, thanks for that view coming in on the cement space as well as the sectors you're liking and the kind of earnings growth that we can pencil in for the Q3 earnings season. On that note, we'll let you go once again. Thanks so much for speaking to us.
If you like this video, then like, share and subscribe to ET Now.